32%. That is how much of the S&P 500 is one sector, technology, one sector. Nearly a third of the index, now energy, the sector that actually moves when oil moves, 3.5%. 32 versus 3.5. You own a total market fund. You have been told it is diversified. You have been told it covers everything, that word, total, as in everything. As in the whole market, 3.5% energy, everything. Here is what you need to know. There are four numbers, then there is one question. If you can answer the question by the end of this, you understand your portfolio better than most people who manage money for a living. The fund most people hold when they say total market is VTI, Vanguard Total Stock Market ETF. As of today, here is what is inside it. Technology, 31.5%. Financial services, 12.5%. Healthcare, 10.2%. Add those three together, 54%, three sectors, more than half your money. Energy, 4.2%. Sit with that for a second. You have more money in your total market fund in a single company called Nvidia than you do in the entire energy sector. Nvidia is nearly 8% of the S&P 500 alone. The whole energy sector, every oil company, every pipeline, every refinery, every driller from the Permian Basin to the Gulf of Mexico, all of them combined, less than one chipmaker in Santa Clara. Remember that number 8 versus 4. Now, you might say that is just how the market works. Market cap weighting, the biggest companies get the biggest slice. Fine. But that is not the point. The point is what you think you own versus what you actually own. Because here is what changed, and nobody sent you a memo. The label did not change, the product underneath it did. In 1980, energy was 25% of the S&P 500. It was the single biggest sector in the index. Not technology, not financials, energy. A quarter of the whole thing. Technology in 1980, about 10%. Now flip those numbers. Technology 32, energy 3.5. The index carries the same name, S&P 500. The label says the same thing, total market, diversified, broad exposure. But the product inside rotated almost completely in 46 years. And the label stayed where it was. That is real. I checked the historical weightings twice. You are reading the label on a loaf of bread. It says whole wheat. You have been buying it for years. Then someone tells you to check the ingredients list. The first ingredient is enriched white flour, 95% white flour, 5% whole wheat. The label never changed, the bread did. That is your total market fund. There is a project manager in the suburbs outside Charlotte, 41 years old. Household income around $112,000. They have been putting money into VTI inside a Roth IRA since they were 29. 12 years of steady contributions. They log into Vanguard maybe once a quarter, check the balance, see the word total, see the green number, close the app. They have never once clicked the sector breakdown tab. Not because they are lazy, because the name told them they did not have to. Now, Brent crude is above $100 a barrel. The EIS says it averaged 103 in March, and they expect it to peak at 115 in the second quarter. Oil has not been this high since 2022. The Strait of Hormuz has been effectively shut down since early March, when Iran declared it closed. 7.5 million barrels per day of crude production got shut in during March. 9.1 million in April. Gasoline just crossed $4 a gallon nationally. The Bureau of Labor Statistics reported March CPI at 3.3% year over year. Jumped from 2.4 the month before. The Fed held rates at 3.5 to 3.75 today. Oil is causing inflation. Inflation is keeping rates higher. Higher rates are pressuring the equity portion of your portfolio. And the sector that actually benefits from higher oil prices, energy, 3.5% of your index. Your portfolio is 100% exposed to the inflation that oil creates. and roughly 4% exposed to the sector that profits from it. That project manager in Charlotte, their Roth $68,000 in VTI. How much of that is energy? At 4.2%, about $2,800. $2,800 of energy exposure in a $68,000 portfolio during what the World Economic Forum called the largest oil supply disruption in post-World War II history. That is not a typo. The project manager does not know this. They opened Vanguard last Tuesday, saw the balance was down about 3% from the month before, closed the app. They did not scroll down to the sector tab. Nobody does. Now here is where this breaks open. 1980, the S&P 500 looked like a completely different product. Energy was 25%. Technology was about 10, financials around 15. The index was built on oil companies, industrial manufacturers, and banks. When oil prices surged in the late 70s, the index had natural insulation. A quarter of its weight went up when oil went up. Today, oil goes up. 3.5% of the index benefits. The other 96.5% gets hit by the inflation that oil creates. Transportation costs, manufacturing inputs, consumer spending compression. The $4 gas that is making people think twice before driving to Costco. You are holding a portfolio that is almost entirely on the wrong side of an oil shock. In 1980, total market meant something. In 2026, total market means mostly technology companies headquartered within a 30-mile radius of each other in Northern California. The label did not change. Here is the next number. The top 10 companies in the S&P 500 now make up roughly 37% of the entire index. In the year 2000, it was 23%. Just 13 companies account for over 40%. That is not an index in any meaningful diversification sense. That is a concentrated bet wearing a 500 company label. The bread, again, 500 ingredients listed, but 3 of them are 90% of the loaf. The S&P 500 also had meaningful commodity exposure through the materials sector back then, about 8% in 1980. Today, materials is about 2%. So the combined commodity-sensitive weight of the index went from roughly 33% in 1980 to about 6% today, 33 to 6. Write that down. Quick, your largest holding. What percentage of it is energy? If you do not know, that is the problem. The index evolved. Your mental model of the index did not. Now, the part that connects all of this to what is happening in your life this month. The Bureau of Labor Statistics reported March CPI at 3.3%. That gasoline number up 18.9% year over year. Airfares climbed 14.9%, food up 2.7%, and accelerating. Amazon slapped a 3.5% fuel and logistics surcharge on third-party sellers last week. Every one of those price increases traces back to oil. Your grocery run, your flight home for the summer, your Amazon order that now costs 3.5% more to ship. All of it connected to crude and the portfolio you built to protect against exactly this kind of moment. 3.5% exposure to the sector driving the shock. These are published sector weights and publicly available data, not personal advice for your specific situation. But these numbers are worth understanding before you close the app again. There is a concept in portfolio theory called uncompensated concentration risk. It means you are taking on extra risk from being overweight in one area without being paid for it through higher expected returns. When 3 sectors are 54% of your fund, you are not diversified across the economy. You are diversified across the technology supply chain. The word total is doing a lot of heavy lifting in that fund name. Gold has been running hard this year. Reuters surveyed 31 analysts who see it averaging close to $4,900 an ounce for 2026. Gold is not in VTI. Treasury inflation-protected securities are not in VTI. Commodity futures are not in VTI. Broad commodity baskets are not in VTI. The instruments that historically respond to exactly the kind of inflation you are experiencing right now. None of them are inside the fund that calls itself total. There are publicly available index funds and ETFs that hold commodities tips, broad commodity baskets covering energy and agriculture and metals. Whether any of them belongs in a specific portfolio depends on that portfolio's goals and timeline and tax situation and a dozen other variables. Only you and a qualified advisor can sort through. You can look at the sector allocation page on Schwab or Fidelity or wherever you hold your accounts. The tab is there. It has always been there. That is not the point of this. The point is this: if you own VTI or VU or SPY or any cap weighted total market fund, and you believe you have built a diversified portfolio that handles an oil shock, you are operating on a mental model from 1980 that the market left behind decades ago. If the next number matters to you, you know where to find it. Same place, same screen. The project manager in Charlotte, they are 41. They have roughly 24 years until traditional retirement age. In those 24 years, there will be more oil shocks, more supply disruptions, more commodity driven inflation spikes. And every single time, 3.5% of their index will benefit, while the other 96.5% absorbs the hit. They do not need to panic. They need to know what they own. That is the question, not whether VTI is good or bad, not whether the S&P 500 is the right benchmark. The question is simpler. Do you know what is inside the fund you are holding? If the answer is the same one most people give, which is some version of everything because it says total, then you have just learned that the label and the contents have not matched for a very long time. Pull up your brokerage account, not the balance, not the performance chart, the sector allocation tab. Look at technology, look at energy, look at the gap between them. The bread label says whole wheat, check the ingredients. There is a broader question underneath this one. It is about what the word diversification actually means. When an index that claims to represent the total market is 54% concentrated in 3 sectors and 4% exposed to the commodity cycle, that is currently rewriting the inflation numbers in your life. That is a different conversation, but it starts with the same tab.